The central narrative has changed. You can stop listening to the financial news now because the expert data confirms the structural failure of the old market order. The attempt by the bullion banks to kill this silver rally is officially over, and they failed. They tried every weapon in the arsenal: massive margin increases, coordinated floods of paper shorts, and painting the tape red to trigger panic. The defense held, and the counterattack was brutal. Silver not only absorbed the selling pressure, but delivered a massive gap up followed by a textbook V-shaped recovery, the loudest possible technical signal that the bear trap slammed shut. This event marks the definitive confirmation that the buy-the-dip mentality has expanded far beyond the typical retail trader. It now encompasses sovereign nations, industrial giants, and institutions with unlimited cash reserves. We are dissecting exactly how the banks tried to stop the price surge, why their traditional weapons misfired for the first time in 4 decades, and what the V-shaped recovery signals about the new established floor price. The failure of the attempt to collapse the price reveals crucial mechanics and psychology. Bull markets are often engineered to impose maximum pain on inexperienced investors, and the recent sharp decline was a classic bear trap setup. The design was simple: force the price below, key psychological trigger $62. $62 trigger the stop-loss orders placed by retailers who were foolishly using excessive leverage. As those stop-losses hit, the banks were able to sell paper shorts into the resulting liquidity, only to absorb that selling pressure themselves. They were selling paper to buy physical, scooping up the metal from panicking retail investors and overconfident bears. Once the artificial selling pressure was removed, the natural demand returned, causing the price to bounce back instantly like a Super Bowl. More critically, the banks deployed their ultimate weapon, the margin nuke. Historically, sudden and sharp increases in margin requirements, the collateral needed to hold a futures contract immediately, cause price collapse because leveraged speculators are forced to liquidate their positions. This worked perfectly in 2011, but today, the market absorbed the margin blow without flinching. This is the clearest indication yet of a fundamental change in market composition. The new buyers are strong hands industrial users, family offices, and sovereign funds who are not leveraged. They simply transfer the necessary cash rather than selling their positions. The failure of the margin nuke is the final all-clear signal that the psychological and technical weakness has been flushed out, clearing the way for the next leg up. But the real structural crisis is rooted in physical supply, starting with the London pivot. For 40 years, the London Bullion Market Association, the LBMA, has been the global capital of price suppression and the seller of last resort. When the price surged, London always found the metal to crush the rally. Not this time. London did not sell. London panicked. Aggressive bid orders coming out of London indicate that the traditional bullion banks themselves have switched sides, now desperately buying physical to cover massive derivative liabilities. This sudden shift highlights the collapse of the real physical float. The headline inventory figures claiming hundreds of millions of ounces in reserve are misleading. 85 to 90% of that metal is allocated. It belongs to ETFs, sovereign funds, or institutional investors, and is unavailable for trade. The float is the unallocated metal, the dealer's pot available for sudden transactions. That float has been systematically drained by 3 years of massive demand from industrial users in nations like India. The float is now effectively zero, forcing the price to rise drastically just to convince diamond hands to part with their metal. This scarcity has broken the bank leasing machine. Historically, banks lease metal to industrial users like solar panel manufacturers who consume the metal and promise to return the equivalent amount later. The breaking point has arrived. Industrial users cannot find bars on the open market to return to the banks. This leaves the banks with a gaping hole in their balance sheets. The leased metal is not coming back. They are now becoming forced, price-insensitive physical buyers in a frantic effort to fill their vaults and cover their liabilities. This fundamental crisis is amplified by a silent bank run. Many large investors hold silver in unallocated accounts, a fractional reserve system similar to cash deposits. The recent volatility has terrified large family offices, which are now demanding conversion from unallocated to fully allocated accounts, requiring physical segregation of specific bars. This demand forces the banks to source actual physical bars on the spot market to fulfill the allocation orders, feeding the ongoing rally in an inescapable feedback loop. The technical focus now moves to the $65 kill zone. This is the gamma wall, the price point where an enormous concentration of call options resides. If the price crosses $65, the banks who sold those options will suddenly owe millions of ounces of discounted silver. As the price approaches this strike price, market makers are forced to delta hedge. They must aggressively buy futures to cover their rapidly increasing risk liability. This mechanism creates a self-fulfilling prophecy, a gamma squeeze. Their buying pushes the price up, forcing more hedging, turning the initial defenders of the resistance into forced buyers. Once $65 is breached, the resistance evaporates entirely. The immediate battleground will be the U.S. market open, traditionally the moment of maximum repression. This time, the U.S. Open will meet a wave of American investor FOMO, which drives the price and compels ETFs to buy even more physical metal. The ultimate counterforce will be the Federal Reserve and the U.S. Treasury, attempting to defend the dollar index DXY to cool the silver rally. If the price holds steady during the critical U.S. morning hours, it signals that the dollar defense has failed. This scenario offers a unique arbitrage opportunity. Mining stocks were sold off hard on Friday and tend to lag the metal price at the beginning of a major rally. The elastic band between the physical price and the miners like FM or PAs is currently stretched, offering a significant catch-up trade opportunity once the silver price confirms the breakout. In conclusion, the new price structure is established. $61.50 has been tested and confirmed as the new buying floor for billions of dollars in capital. Furthermore, seasonal factors amplify this move through institutional FOMO. Hedge funds are compelled to engage in window dressing, buying the winning assets, like silver, at the end of December to artificially beautify their annual reports and avoid looking incompetent to their clients. This creates an institutionally driven tailwind that is completely price insensitive, guaranteeing the extension of the rally. Finally, we must consider the theory of the Max Pain trade. A decline scenario A would only hurt the diehard silver bugs, who would simply buy more. An increase to $75 or above scenario B causes maximum pain to the banks holding short positions, the unallocated investors, and the industrial users. Since markets are fundamentally sadistic and always seek the path that inflicts the most agony on the largest number of participants and institutions, scenario B is the most likely outcome. Silver has confirmed a historic pivot. The physical world is reclaiming its value. You cannot print a solar panel. Friday was a definitive test of faith. The failure of the bear trap, the palpable panic in London, and the clear opening to the $65 gamma wall confirmed that wealth is now structurally transferring from financial paper assets to tangible, physical assets. The strategy remains clear. Volatility will accelerate, accumulate physical metal, and unleveraged mining stocks. Let the structural scarcity and the physics of the short squeeze do the work for you. Stop listening to the mainstream news right now because the data confirms what they are desperately trying to hide. The silver short squeeze is now structurally unstoppable. Last week, the bullion banks tried to kill the rally using every weapon in their 40-year arsenal, attempting to drown the market with paper shorts and painting the tape red. They failed. Not only did they fail, but silver registered a massive gap up followed by a spectacular V-shaped recovery. A classic bear trap snapping shut right in their faces. This brutal reversal is the definitive market signal confirming that the mentality of buying the dip has expanded far beyond retail investors. It now encompasses sovereign nations and massive industrial users. We are going to dissect precisely how the banks tried to murder the price, and why, for the first time in 4 decades, their ultimate weapon misfired, setting a confirmed floor for the next explosive move up. The recent artificial dip was engineered with ruthless precision. Bull markets are designed to maximize pain, and this drop was a textbook bear trap. The banks surgically forced the price below key psychological levels, specifically below $62, purely to trigger the stop-loss orders of leveraged retailers and weak hands. They weren't selling to go short, they were selling to buy, absorbing the liquidity created by panicked retail and overconfident bears. As soon as that artificial selling pressure was removed, the demand side took over, causing the price to bounce back like a Super Bowl. But the most critical failure was the collapse of their ultimate defensive weapon, the margin nuke. Historically, dramatically hiking margin requirements crushed leveraged investors and collapsed the price, just as it did in 2011. This time, the market absorbed the blow. The reason is a fundamental shift in market composition. Today, the buyers are strong hands industrial users, family offices, and sovereign funds who are not leveraged. When the margin requirements went up, they simply transferred the necessary cash instead of selling. The failure of the margin nuke is the all-clear signal that the traditional means of market suppression are dead, guaranteeing the next leg higher. Now we pivot to the physical reality, starting with the London pivot. For 40 years, London, the home of the LBMA, has been the global capital of price repression and the seller of last resort. What happened this week? London didn't sell. London panic bought. Aggressive bid orders coming out of London indicate that the massive bullion banks have been forced to switch sides because of growing physical liabilities. This leads us to the collapse of the float. When you hear that there are 800 million ounces in inventory, that number is intentionally deceptive. 85 to 90% of that metal is already allocated. It's owned by ETFs, large institutions, or sovereigns, and is unavailable for sale. The true float is the remaining unallocated metal, the dealer's pot available for trading. Aggressive non-stop buying by India and industrial users over the last 3 years has drained this float to zero. This liquidity crisis means the price must rise drastically to convince genuine diamond hands to sell. Crucially, the leasing machine has broken. Banks traditionally lease silver to industrial users. These users consume the metal but promise to return it. The breaking point is that industrial users, especially refineries and solar panel manufacturers, cannot find bars in the open market to fulfill their obligation to return the metal to the banks. Consequently, the bullion banks now have a massive unhedged hole on their balance sheets. They are becoming forced buyers, physical short covers insensible to price, desperately buying to fill their vaults. Adding to this structural stress is the silent bank run. Many institutional investors and wealthy family offices hold silver in unallocated accounts, which is essentially a fractional reserve system operated by the banks. The recent volatility has spooked these giants, who are now demanding the conversion of their unallocated paper holdings into fully segregated, allocated physical metal. This mass demand forces the banks to buy spot bars on the open market simply to honor their clients' conversion requests, thus fueling the physical rally. This leads us to the technical roadmap in the $65 kill zone. $65 is the gamma wall, the strike price where there is an immense concentration of call options. If the price crosses this level, the banks who sold those options are suddenly liable for millions of ounces of metal at a steep discount. As the price approaches $65, market makers are forced to delta hedge, meaning they must buy futures contracts to cover their risk. This obligatory buying elevates the price, forcing more hedging, triggering a powerful gamma squeeze. Above $65, the defenders become forced buyers, and resistance vanishes. The battle will intensify at the U.S. market open, traditionally the hour of repression, which will face a tidal wave of American FOMO as retail investors and ETFs jump in, forcing more metal purchases. Pay attention to the dollar index. The Federal Reserve and Treasury will attempt to defend the dollar to cool the rally. If silver holds steady through the U.S. morning, it confirms the dollar defense has failed. Finally, look closely at mining stocks. Miners were intentionally sold off last week and often lag the metal's initial surge. The elastic between the metal price and the stock price is extremely stretched, presenting a clear arbitrage opportunity. If silver holds its gains, the miners will have a massive catch-up trade. The new structure of pricing is now confirmed. $61.50 was the buying price for billionaires, cementing a complete overhaul of the metal's valuation model. We also benefit from seasonal institutional factors. Hedge funds are currently engaging in year-end window dressing, meaning they are forced to buy the year's winning assets, like silver, to avoid looking incompetent to their clients. This creates a relentless price-insensitive institutional tailwind that will propel the rally through year. Consider the theory of maximum market distaste. A crash scenario A hurts only the existing silver bugs, who simply buy more, but a surge toward $75 and beyond. Scenario B inflicts maximum institutional agony on the banks, the shorts, the unprepared industrial users, and the vast pool of unallocated paper investors. Since markets are fundamentally sadistic and always seek the path that inflicts the most agony on the largest number of participants and institutions, Scenario B is the most likely outcome. Silver has confirmed a historic pivot. The physical world is reclaiming its value. You cannot print a solar panel. Friday was a definitive test of faith. The failure of the bear trap, the palpable panic in London, and the clear opening to the $65 gamma wall confirmed that wealth is now structurally transferring from financial paper assets to tangible, physical assets. The strategy remains clear. Volatility will accelerate. Accumulate physical metal and unleveraged mining stocks. Let the structural scarcity and the physics of the short squeeze do the work for you. The news media is screaming about volatility, but you must stop listening to them. What happened last week was the final, definitive test of this market. The banks launched their nuclear option, margin hikes, flooding the market with paper shorts, painting the tape red. They tried to kill the rally. They failed. Instead, we witnessed a massive gap up and a violent, V-shaped recovery, a textbook bear trap snapping shut. This outcome confirms that the buy-the-dip mentality has moved beyond retail. It is now the mandate of sovereign nations and industrial giants, validating the structural shift that makes this short squeeze unstoppable. Our analysis must dissect precisely how the banks tried to murder the price and why, for the first time in 40 years, that weapon misfired. Let's first look at the mechanics and psychology of the failed bear trap. Bull markets are engineered to inflict maximum pain, and the recent sell-off was a classic liquidity grab. The banks engineered the pain by forcing the price below key psychological levels, $60, $62, to trigger stop-loss orders from weak hands. Crucially, they were selling not to crash the market, but to buy. They absorbed that panic selling, removing the artificial supply and allowing natural underlying demand to instantly launch the price back up like a super ball. Most importantly, the ultimate weapon, the margin nuke, failed entirely. Historically, hiking margin requirements successfully collapsed the market, as we saw in 2011. Today, the market simply absorbed the blow. This structural change is everything because the composition of the buyer base has changed. The buyers today are strong hands, industrial users, family offices, sovereign funds. They are not leveraged, so when margin requirements rise, they simply transfer the necessary cash rather than selling their position. The failure of the margin nuke is the all-clear signal for the next violent leg higher. This failure is rooted deep in physical reality, and the evidence comes straight out of London. Historically, the London Bullion Market Association, LBMA, has been the capital of repression, acting as the seller of last resort for 4 decades. But now, London didn't sell. It panicked. Aggressive bid orders indicate that the bullion banks themselves, facing massive physical delivery liabilities, have fundamentally flipped sides. We are witnessing the collapse of the real market float. Do not confuse total inventory, say, 800 million ounce, with the float, which is the unallocated metal actually available for transactions. 85 to 90% of inventory is locked up, owned by ETFs and sovereign nations. The float, the dealer's available pot, has been systematically drained by aggressive industrial and Indian buying over the past 3 years. Liquidity is now non-existent, forcing prices to spike drastically just to convince diamond hands to part with even a single ounce. This scarcity is intensified by the broken leasing machine. Banks lease silver to industrial users who promise to return the metal. But today, industrial users, refineries, solar panel manufacturers cannot find bars on the open market to fulfill their promise to the banks. The banks now have a massive unfillable hole on their balance sheets. They are now forced buyers, insensitive to price, needing to cover their physical shorts just to plug their vaults. This leads directly to the silent bank run. Family offices, spooked by the recent volatility, are now demanding the conversion of their unallocated fractional reserve accounts into fully allocated, physically segregated metal. This demand forces the banks to buy spot metal immediately to fulfill those allocation orders, relentlessly feeding the rally. This brings us to the technical roadmap and the $65 kill zone. $65 is the strike price where there is an enormous concentration of outstanding call options. If that price is crossed, the banks who sold those options are instantly on the hook for millions of ounces that must be delivered at a discount. As the price approaches $65, market makers are forced into delta hedging. They must buy futures contracts to cover their exposure. This triggers a powerful feedback loop. Their buying raises the price, forcing more hedging, leading to an explosive gamma squeeze. Above $65, the traditional price defenders are forced to become aggressive buyers, and resistance vanishes entirely. The moment of truth will be the U.S. market open. Traditionally the hour for price repression, the open will now face a tidal wave of American fear of missing out, driving price and forcing ETFs to acquire even more physical metal. If the price holds stable through the U.S. morning, the dollar's defense has failed. This structural squeeze is also creating a critical arbitrage opportunity. Mining stocks were sold off last Friday and often lagged the metal price in the initial surge. The elasticity between the metal and the miners is stretched. If silver holds, the miners are poised for a massive catch-up trade. The new structure is irrevocably set. $61.50 has now been established as the definitive floor price for sovereign buyers and billionaires, representing a complete shift in the valuation model. We are seeing institutional FOMO kick in hard now. Hedge funds are forced to window dress by the winning assets like silver at the end of December to beautify their annual reports and avoid looking incompetent to clients. This creates a powerful price-insensitive institutional tailwind, pushing the rally into overtime. Remember the Max Payne trade theory. A crash scenario A only hurts the silver bugs, who will simply buy more. An unstoppable surge to $75 or higher scenario B causes maximum agony for the banks, the shorts, the industrial users, and the vast pool of unallocated paper investors. Since markets are fundamentally sadistic and always seek the path that inflicts the most agony on the largest number of participants and institutions, Scenario B is the most likely outcome. Silver has confirmed a historic pivot. The physical world is reclaiming its value. You cannot print a solar panel. Last Friday was a definitive test of faith. The failure of the bear trap, the palpable panic in London, and the clear opening to the $65 gamma wall confirmed that wealth is now structurally transferring from financial paper assets to tangible, physical assets. The strategy remains clear. Volatility will accelerate dramatically. Accumulate physical metal and unleveraged mining stocks. Let the structural scarcity and the physics of the short squeeze do the work for you. The war for silver is over. Last week, the banking cartel threw their final punch. They launched a textbook attack, hiking margin requirements, flooding the market with paper shorts, and painting the tape blood red. But for the first time in 40 years, that punch did not land. The market didn't just hold. It rebounded with a massive V-shaped reversal, a bear trap snapping shut on the manipulators. This wasn't just a technical bounce, it was a structural signal. It confirms that the buy-the-dip mentality has expanded far beyond retail investors. It now encompasses sovereign nations and massive industrial giants. We need to dissect exactly how they tried to kill the price and why. Finally, their weapon misfired, establishing the new floor price for this entire rally. Bull markets are designed to inflict maximum pain. The recent downturn was the classic liquidity hunt. Banks forcing the price below key psychological levels, like $62 to trigger retail stop-loss orders. But here's the crucial pivot. The banks were selling paper only to buy physical, absorbing all the forced liquidity from panic sellers and overconfident bears. Once that artificial selling pressure was removed, the natural demand kicked in, causing the price to bounce like a super ball. More critically, their ultimate weapon, the margin nuke. Historically, arbitrarily raising margin requirements has crashed rallies instantly. This time, the market simply absorbed the blow. This signifies a composition change. The market is now dominated by strong hands, industrial users, family offices, and sovereign funds who are not leveraged. They don't sell. They simply transfer the required cash. The complete failure of the margin nuke is the definitive all-clear signal for the next leg higher. The physical market confirms this failure. The biggest signal came from the London pivot. For 4 decades, the LBMA, London's trading hub, has been the capital of repression, acting as the seller of last resort. Last week, London didn't sell. It panicked. Aggressive bid orders indicate that the bullion banks themselves are changing sides due to crushing liabilities. This leads us to the collapse of the float. Don't be fooled by high inventory numbers. 85 to 90% of reported stock is allocated metal, owned by ETFs or sovereign entities and unavailable. The float is the unallocated metal, the dealer's available inventory. 3 years of relentless purchasing by India and industrial consumers have drained this float to zero. This liquidity crisis forces the price to rocket simply to convince reluctant diamond hands to sell. Furthermore, the banking leasing machine is officially broken. Banks lease metal to industrial users who promise to return it. But since the industrial users' solar, electronics are consuming the metal and cannot find bars on the open market to fulfill their obligation, the leased metal isn't coming back. Banks now face a hole in their balance sheet. They become forced, price-insensitive physical short covers, desperately trying to refill their vaults. Adding to this structural stress is the silent bank run. Volatility has spooked smart money. Large family offices are now demanding conversion from unallocated fractional reserve accounts to fully allocated, physically segregated accounts. This massive, sudden demand forces banks to buy physical bars in the spot market to fulfill allocation orders, thereby relentlessly feeding the rally. The technical roadmap points directly to the $65 kill zone. This is the strike price where an immense concentration of call options resides. If silver crosses $65, the banks who sold those options instantly owe millions of ounces at a discount. As the price approaches, market makers are forced to delta hedge buying futures to cover their risk. This creates a relentless feedback loop. Their buying raises the price, forcing more hedging, triggering a gamma squeeze. Above $65, the institutional defenders instantly become forced buyers, and resistance effectively vanishes. The moment of truth arrives at the U.S. market open. This traditionally repressed hour will now face a tsunami of American retail FOMO, forcing massive ETF physical buying. If the price holds steady during the U.S. morning, it signals the failure of the final defense attempted by the Federal Reserve and Treasury, the defense of the U.S. dollar index. This rally also provides a massive arbitrage opportunity in mining stocks. Miners were sold off last Friday and often lagged the metal's initial surge. The elastic between the metal price and the equity price is stretched to the breaking point. If silver holds its gains, expect mining stocks to explode in a rapid catch-up trade. The attempted crash established one thing definitively: the new structural floor. $61.50 is now the established billionaire buying price, marking a total revaluation of the asset. This rally will be further compounded by powerful seasonal factors. Hedge funds engage in window dressing, forcing them to buy winning assets like silver at the end of December to embellish their annual reports and avoid looking incompetent to their clients. This creates institutional, price-insensitive buying momentum that extends the rally further into the new year. Now, let's consider the maximum pain trade. A crash scenario A only hurts the committed silver bugs, who simply buy more. Maximum pain is inflicted by a massive, sustained rally above $75. Scenario B. This crushes the banks, the industrial users who haven't hedged, and the non-allocated paper investors, since markets are fundamentally sadistic and always seek the path that inflicts the most agony on the largest number of participants and institutions. Scenario B is the most likely outcome. Silver has confirmed a historic pivot. The physical world is reclaiming its value. You cannot print a solar panel. Last Friday was a definitive test of faith. The failure of the bear trap, the palpable panic in London, and the clear opening to the $65 gamma. Wall confirmed that wealth is now structurally transferring from financial paper assets to tangible, physical assets. The strategy remains clear. Volatility will accelerate dramatically. Accumulate physical metal and unleveraged mining stocks. Let the structural scarcity and the physics of the short squeeze do the work for you. Stop listening to the news. Expert data confirms the short squeeze is now unstoppable. The battle is over. The banks attempted their final, desperate move last week to kill the silver rally. They flooded the market with paper shorts. They painted the tape red, and they deployed the ultimate weapon, a massive margin requirement hike. For 40 years, that weapon has guaranteed collapse. But this time, the attack failed. Silver registered a massive gap up and completed a fierce, unmistakable V-shaped recovery, confirming that the bear trap slammed shut on its architects. This move is the definitive signal that the buy-the-dip mentality has expanded far beyond retail investors. It is now the adopted strategy of sovereign nations and industrial giants. we must dissect exactly how the banks tried to destroy the price and, crucially, why their primary weapon failed for the first time in nearly half a century. Bull markets are engineered to shed weak investors through maximum pain. The recent sell-off was a textbook bear trap. The banks actively forced the price below psychological triggers, targeting key levels like $62 and $60 to ignite a cascade of retail stop-loss orders. But this time, they were selling paper just to absorb that liquidity, buying up the physical metal handed over by the panicked masses and the overconfident bears. As soon as that artificial selling pressure was removed, the natural demand side, the industrial buyers and strong-handed funds, shot the price back up like a Super Bowl. The most critical event, however, was the failure of the margin nuke. Historically, hiking margin requirements, the amount of cash needed to hold a contract, immediately crushed speculators, causing a collapse as seen in 2011. Today, the market absorbed the blow. This is because the composition of the market has fundamentally changed. It is now dominated by strong-hands industrial users, sovereign funds, and family offices who are not leveraged. When faced with the higher margin call, they didn't panic and sell, they simply wired the necessary cash. The failure of the margin nuke is the all-clear sign that the structural defenses against silver, as true price discovery, are crumbling. The failure of the physical market defenses begins in London. For 4 decades, London, the LBMA, has served as the global capital of price repression and the seller of last resort. But today, London didn't sell. London panicked. The aggressive bid orders emerging from the world's financial epicenter indicate that the bullion banks themselves, facing unbearable liabilities, have pivoted and are now forced buyers. This panic is driven by the total collapse of the available market float. We are constantly misled by reports of large total inventory figures like 800 million ounces, but 85 to 90% of that metal is already allocated down by ETFs, governments, or large institutions and is unavailable for trading. The true float is the small pot of unallocated dealer metal. An aggressive buying by India and industrial users over the last 3 years has drained it to effectively zero. This crisis of liquidity forces the price to rocket upward to find a level high enough to convince true diamond hands to sell. The core of the short squeeze mechanism is the broken leasing machine. Banks historically leased silver to industrial users, who consumed the metal and promised to return the equivalent ounces later. The breaking point is now here. Industrial users, the solar manufacturers and electronic fabricators, cannot find bars on the open market to fulfill their obligation to the banks. This means the banks have an unrecoverable hole in their balance sheet. They are now compelled to become price-insensitive buyers, performing physical short covering to refill their own vaults and cover their liabilities. Adding fuel to this inferno is the silent bank run. Many large institutional investors hold silver in unallocated accounts, operating on a fractional reserve system. The recent volatility has terrified family offices, who are now demanding that their unallocated accounts be converted immediately into allocated, physically segregated bars. This forces the banks to purchase spot bars to fulfill those segregation orders, creating an unprecedented feedback loop of forced institutional buying that relentlessly drives the rally. All this physical pressure is culminating in the $65 gamma kill zone. $65 is not just a psychological number. It is the strike price where a massive concentration of institutional call options resides. If the price crosses $65, the banks, who are the primary sellers of those options, will suddenly owe millions of ounces of silver at a deep discount. As the price nears this point, market makers are forced to delta hedge, meaning they must buy futures contracts to cover their risk exposure, which mechanically lifts the price higher. Above $65, this transforms into a gamma squeeze. The resistance vanishes, and the defenders of the low price are forced to become the most aggressive buyers. The moment of truth is at the U.S. market open, traditionally the hour used for price repression. If the U.S. session opens and is met with a tidal wave of American FOMO, fear of missing out, and the price holds firm, it signals that the Federal Reserve and Treasury's defense of the dollar has failed. Furthermore, this opens up a crucial arbitrage play. Mining stocks like FM and POs often lag the initial metal rally. The elastic between the metal price and the stock price is now stretched to a breaking point. If silver holds, the miners will snap back violently in a massive catch-up trade. The failed bear trap has established $61.50 as the new buying floor for institutional players, confirming a complete shift in the valuation model. This surge is getting a guaranteed tailwind from institutional window dressing. As the year-end approaches, hedge funds are forced to buy winning assets like silver to beautify their annual reports and avoid appearing incompetent to their clients. This creates institutional FOMO that is completely insensitive to price. Finally, we must consider the maximum pain theory. A market drop scenario A only hurts the dedicated silver bulls, who simply buy more. Maximum pain scenario B is a surge to $75 and beyond, inflicting catastrophe on the banks who are short the industry that needs the metal, and the investors who failed to allocate their accounts. Since markets are fundamentally sadistic and always seek the path that inflicts the most agony on the largest number of participants and institutions, scenario B is the most likely outcome. Silver has confirmed a historic pivot. The physical world is reclaiming its value. You cannot print a solar panel. Last Friday was a definitive test of faith. The failure of the bear trap, the palpable panic in London, and the clear opening to the $65 gamma. Wall confirmed that wealth is now structurally transferring from financial paper assets to tangible, physical assets. The strategy remains clear. Volatility will accelerate dramatically. Accumulate physical metal and unleveraged mining stocks. Let the structural scarcity and the physics of the short squeeze do the work for you.